Can the next property boom be set to start already? I mean, sure, property prices have fallen in many areas around the country, but the median house price in Sydney is still over $1.2 million. In Melbourne, it's just under $900,000. In Brisbane, it's just under $800,000. I mean, even if you look at regional New South Wales, the median house price is over $700,000. These prices are not cheap by any stretch of the imagination. And after 10 interest rate rises, and with so much noise in the media about people struggling to pay their mortgages and being at risk of defaulting on their loans, can the recent price increases really be the start of a new property boom? Or is it just a dead cat bounce? Well, that's exactly what we'll cover in this video. And if you stay until the end, I'll even show you why this whole fear that people have about people defaulting on their loans and fire selling their properties is not going to work the way the media has portrayed. Hi, it's Nero here, and if we're going to talk about the start of a new property boom versus a dead cat bounce, we first need to see, well, has the property market reached the bottom? Well, according to this article from the Australian Financial Review, the Sydney and Melbourne housing markets have bottomed. The housing price downturn is over for Sydney and Melbourne, according to the key property data analysts who have called the bottom of the market, saying the record return of migrants would bolster prices. While some housing economists said prices might still have further to fall if interest rates continued to rise, even those who aren't yet calling a bottom said the faster than expected return of immigration after the pandemic would underpin the housing market. The article then goes on to say, CoreLogic, SQM Research, PropTrack, and RBC Capital Markets have all declared house prices had bottomed out in the two biggest housing markets amid a growing number of housing indicators showing a marked upturn. Now, this is really important because you don't just have one research house or one set of experts talking about the fact that the property market has bottomed out. You've got multiple research houses, including SQM Research, who their CEO has often been known as a bit of a property bear, predicting the market to fall. Even they are expecting the property prices are going to rise. So if you are an investor who wants to invest based on data, when you have different data sources all saying the same things, it makes it a very compelling argument. As more data flows have come through across housing finance, consumer sentiment, vendor discounting, and sales volumes, it seems the national housing market downswing may have bottomed out in early March, said CoreLogic head of research Eliza Owen. A record return in overseas migration was unexpected, and it has left housing demand far outstripping supply, which has contributed to the start of a more sustained upswing in value. Look at the terms that she's using, saying demand far outstripping supply and a more sustained upswing in value. But before you can believe me that we're at the start of the next property boom, and I personally believe we are, and even though this article only talks about Sydney and Melbourne, I think there are many other areas that have also turned the corner in Australia, you're probably going to have two objections. The first one is, how do we know that this upturn in property prices in the last couple of months isn't just a dead cat bounce? Now, if you're not sure what that term refers to, here's the definition from the Oxford Dictionary. Dead cat bounce, a temporary recovery in share prices after a substantial fall caused by speculators buying in order to cover their positions. So in simple terms, it's a term that's come from the share market, which refers to people going in to buy shares when they think the share prices hit the bottom, and then share prices rise a bit, and then all of a sudden something happens, share prices turn around and people start selling. Okay? That's essentially what a dead cat bounce is. Okay? Now, the problem is, though, then when people start thinking that just because shares can be an investment vehicle and property can be an investment vehicle, that the fundamentals are the same. That's totally not the case. I mean, you could literally buy shares in a company today and then decide to sell them tomorrow, okay? But property is a much more illiquid vehicle, okay? So what that means is that you could make an offer on a property and it could be accepted today, but by the time you actually take ownership of the property, that's going to take you probably about 6 weeks, okay? And then how likely are you to turn around and sell it the very next day? Okay, it's just too expensive because the transaction costs of buying and selling. So what I mean by that is costs like stamp duty when you buy or real estate agents' fees when you sell are too expensive for you to be able to sell straight away. And so therefore, you never get this scenario in the property market where people buy property and then look to sell immediately, okay, because they think they've got it wrong. It just doesn't work that way in the property market. And that's why dead cats don't bounce in the property market. In other words, if there is a shift in market direction, it's a sustained shift. And so that's why so many data research houses and research experts are calling the bottom of the market, because it's very clear that the market is changing direction in multiple areas around Australia, and that's going to be a sustained shift. The second objection, though, that you might have about, well, how on earth can property prices rise, is all this talk about the fixed rate mortgage cliff. All right, now if you're not aware of what that is, it's essentially a term that's been coined in the media. It's got a lot of airtime, and what it refers to is that lots of people in around about 2021 fixed their mortgages when interest rates were at record lows. Now, many of those fixed rate periods have expired, and mortgage holders are now facing much higher interest rates, and therefore the argument goes that because their interest payments have increased so much, mortgage holders won't be able to afford their repayments and they're going to have to fire sell, and you can grab yourself a bargain. All right, now, first of all, I'm not even going to talk about why there won't be anywhere near as many mortgage holders who are defaulting as people think, because the fact is some people will default on their mortgage. Right? Or some people, more accurately, will want to sell when they're in financial distress. But why then isn't it going to crash the market? Well, let me give you an actual example here, okay, to illustrate this. There was a property that we were looking at, and it was the market value I knew based on similar sales was $580,000. Yet the property was listed for $540,000. So when I inquired to find out why and get some further information, found out that it was a mortgage holder who was in financial distress and who needed to sell. And I was able to find out that they would actually take not $540,000, but actually $530,000. Now remember, market value is $580,000. Okay. Now, unfortunately, I didn't have a client who that property suited, but I was still keen to observe what happened. So what do you think the property then sold for? Mind you, it sold within 3 weeks. Okay, so very quickly. It didn't sell for the $530,000 that the vendor was willing to accept. It didn't sell for the $540,000 that was listed online. It didn't even sell for the $580,000 that I thought was fair market value. The property sold for $589,000. Why? And this is the assumption that so many people have made unknowingly, and that's why they're getting their argument about property prices wrong. And here it is. If you are a buyer looking to try and get a bargain because someone is in financial distress, that only works if there's one seller and you're the only buyer. Then you're negotiating with the seller, and then you might be able to get a discount. But what we have right now is a massive supply shortage in many areas around Australia. We have more buyers than available properties. So if you have a property where the owner is in financial distress and you think you're going to get a bargain, but then you find that, hold on, you're one of 2 or more buyers, well, now you're no longer negotiating with the seller. You're competing with other buyers, almost like you're at an auction. And that's what's happened in this particular case. There were actually 4 offers made on the property, and so the highest offer won. And that's the key takeaway message here, is that although some mortgage holders may be in financial distress, the demand and supply metrics, the undersupply that we have right now in so many areas around the country is a more powerful force. So when you see buyers who are selling because they're in financial distress, if you have multiple buyers, as is inevitably going to be the case when you're looking at quality property in quality areas, you're not going to get that massive discount, which means those areas are not going to crash. Okay? They're going to hold their value and start to rise again. And that's what we're seeing. We have an undersupply problem in Australia, not an oversupply problem. And this is why property prices are not only just going to stay strong or stay where they are, they're going to rise very quickly in certain areas. Check this article out. House prices set for speedy recovery, CoreLogic. Sydney's house prices are poised for a sharp recovery, which is not far off, as the market continues to rise faster than expected, CoreLogic says. Values jumped by 1.4% in March, more than 4 times faster than the previous month, and the sharpest increase since October 2021, data from CoreLogic shows. Melbourne, Perth, and Brisbane also moved into positive growth, posting price increases of 0.6%, 0.5%, and 0.1% respectively. Now remember, these are aggregate data. We look at markets within markets. And as you've probably seen from my past videos, I talk about the fact that when you invest in a city, you don't really invest in the city, you invest in the actual suburb. So this is just talking about general citywide data. In each of these cities, there are suburbs that are doing worse. There are suburbs doing a lot better. Tim Lawless, CoreLogic's research director, said a combination of low stock, an extremely tight rental market, and additional demand from overseas migration fueled the earlier than expected turnaround in prices in those capital cities. And just as the property market is starting to rise, lenders are starting to reduce the interest rate on their fixed rate loans. Commonwealth Bank cuts fixed rate home loans. The country's largest mortgage lender has slashed its fixed rate borrowing costs in a move that will add further momentum to a post-Easter residential market picking up faster than many analysts expected. So what does this all mean? Well, look, this isn't financial advice, but if you look at the data, it certainly looks like if you can afford to buy an investment property, now is the time to buy. There are too many differing sources of research, differing sources of data that all point to that same conclusion, that we are at the start of the next growth phase. But the only question then is, where do you buy? You can't just buy where friends and family might have bought in the past. You can't buy blindly. You need to do your due diligence. And look, if you want help with that, check the link out in the description to get a copy of my book, both the audio version and the digital version, totally for free. And then make sure you subscribe to this channel to see more videos like this. I'll see you next time.